Welcome to Wealth Wisdom. If you have ambitions to achieve financial success, please leave yes in the comment, and we are here to help you obtain insight and build wealth. The book we are going to share today is How to Read a Financial Report by John A. Tracy and Tage Tracy. Financial Statements 101. Financial statements provide a wealth of critical insights into a company's financial performance and health. Let's walk through the three main statements and what they tell us. First, the balance sheet. The balance sheet is like a snapshot of the company's financial position at a particular point in time. It lists the company's assets, liabilities, and equity. Assets are all the things the company owns: cash, inventory, buildings, and so on. Liabilities are things that the company owes, like loans, accounts you need to pay, and taxes. Equity is the shares owned by the company's shareholders. By examining the balance sheet, you're able to see a company's ability to turn assets into cash to cover any short-term obligations, what we call a company's liquidity. You can look at its capital structure, which is a comparison of the debt and equity, the amount you owe and the amount your shareholders own, to your actual capital. Finally, you can see your working capital, which is the excess of current assets over current liabilities. In other words, this is the amount of money or assets you'd have if you were to pay off everything, and shows a company's ability to fund things in the near term. Next, you've got the income statement. This summarizes the company's revenue and expenses over a period of time. Revenue is the amount of money you've got coming into the company, but remember that it's different from profit. You could be bringing a lot of money in, but it might be costing you just as much to make it happen. Your profit is the amount of money you have left after all your expenses are paid. The key things you're looking for here are the revenue growth trends, performance by business segment, and profitability margins. That last one is a bit confusing, so let's take a closer look. Your profitability margins look at your profit in a couple of different ways. There's the gross profit margin, that compares your profit to all your sales. How much money does one sale make? The operating margin is similar, but considers the cost of what it took to get that sale over the line. Your net profit compares your profit to the revenue. Maybe you have a lot of money coming in, but it all might be funneled back into expenses. Your last financial statement is the statement of cash flow. We're going to look at this in a bit more detail in a moment, but think of it as tracking where cash came from and where it's being spent over a period of time. Looking at all three financial statements together provides a comprehensive view of the company's financial situation. They interact with each other, and analysts will look at all three to gain critical insight into the company's health. For example, a statement might show sluggish revenue growth, but healthy margins and a strong cash flow with ample working capital. No one number can tell you everything about a company's financial position. By looking at all three statements, you'll paint a full picture of the company's performance, health, structure, and cash flows. Before we continue, if you are interested in this topic, please consider subscribe and give us a thumb up. Let's continue. Following the money. Let's zero in on the statement of cash, as this tracks where a company's cash came from and where it was spent during a period. It helps investors follow the money flow through a business, and managers make decisions that drive the company. This statement divides cash flows into three buckets. First up, we have cash from operating activities. This is the money generated from the bread and butter of your business, making and selling your products. The starting point is net income, which then gets tweaked for fluctuations in things like inventory, amounts owed to you, and amounts you owe to others. These adjustments change the accrual-based net income, essentially money you've earned but haven't actually received, into actual cash coming in and going out. Take net income, for instance. It might count products sold on credit, but that money isn't in the bank just yet. The real impact on your cash flow won't show until that transaction actually occurs. So, the cash flow from sales is essentially your revenue minus the money still owed to you, also known as receivables. The same principle applies to your expenses. The cash doesn't leave your account until you've actually made the payment, and only then does it show up on your income statement. The second chunk of your cash flow statement zeroes in on investing activities. This involves buying or selling long-term assets such as real estate, machinery, or other investment vehicles. These purchases are known as capital expenditures, the funds you spend to keep the business humming and potentially expand its reach. Last but not least, we delve into financing activities. This segment shows how the business secures capital, either through loans or by offering company shares. You'll also see outgoing payments, like dividends, distributed to shareholders. Increasing your debt boosts your cash inflow, while settling that debt or paying dividends results in cash going out. By tracing the flow of money across these categories, you get a clear picture of the company's financial strategy and any looming capital needs. Questions like, is the business generating enough money from its core operations, or are the levels of capital expenditure and debt a cause for concern, become easier to answer. Your cash flow statement acts as the linchpin, tying the balance sheet and income statement together. Tracking the money gives you a deeper understanding of a company's financial health and management priorities. A thorough financial analysis is never complete without a good hard look at this crucial document, reading between the lines of a financial report. You may have already noticed that understanding a company's financial health involves more than just looking at the raw numbers, it's about how those numbers interact. While financial statements provide the baseline data, it's the financial ratios that enable you to dive deeper. Calculating these ratios allows both investors and managers to analyze and compare a company's financial situation. We've discussed some of these ratios already. Gross margins illustrate profitability after production costs are subtracted. Operating margins include expenses like R&D and marketing. Net margins show the final profitability after interest and taxes have been considered. We call these profitability ratios, and they give you a solid grasp of a company's earning capabilities under different conditions. There are 6 primary categories of financial ratios. Apart from profitability ratios, these include efficiency, liquidity, leverage, and valuation ratios. Let's take a brief look at each of them. Efficiency ratios examine the effective use of assets and operational management. They include metrics like inventory turnover, receivables turnover, and asset turnover. How quickly are your products moving or being paid for? How much of an input do you need to buy in order to produce the products you are moving? What's being wasted? Liquidity ratios assess the company's ability to meet short-term financial commitments. Metrics here include the current ratio, which gauges your capability to meet financial obligations within a year. Quick ratios focus on assets that can be quickly converted to cash, fast. Leverage ratios assess the balance sheet structure with things like the debt-to-equity ratio, which measures your total liabilities against shareholder equities. You might need to look at the interest coverage ratio if you want to evaluate the cushion a company has for covering interest payments. Leverage ratios are focused on identifying financial risks as well as the long-term stability of a company. Lastly, valuation ratios examine the market value of a company relative to key financial metrics like earnings. We won't delve too deep here, but know that these ratios help determine the value you get for your financial investment. Benchmarking these ratios against historical data, competitors, and industry standards offers context. Are margins and turnover improving or declining? How does leverage compare with similar companies? The story behind ratios extracts deeper insights that raw numbers alone can't provide. For managers or investors, these are what facilitate more informed decision-making. Don't forget to check the footnotes. Every financial statement is likely filled with tiny numbers and symbols that point you to the fine print at the page's bottom. While dense and hard to interpret, footnotes are critical. They fill in details and nuances that financial statements alone can't provide. From lawsuits and labor disputes to assets pledged as collateral, footnotes disclose vital information. They also explain accounting policies, ratio calculations, and offer additional schedules. Footnotes, however, are often challenging to read. Legal jargon like heretofore and notwithstanding make them less accessible. This complexity can sometimes obscure crucial details within long paragraphs or intricate grammar, requiring specialized knowledge to unpack. Although designed to support transparency and full disclosure, footnotes can sometimes do the opposite. They may include technical or controversial topics, and language can sometimes be deliberately opaque. Corporate transparency isn't without its boundaries. For the most effective approach, focus on footnotes that demand your attention, those related to unusual events, changes, or estimates, for example. For the rest, a quick skim will suffice. Understanding footnotes is an art that comes with practice, but it's essential for fully grasping a financial statement's context. Hidden within these footnotes are the keys to understanding the complete financial narrative. Getting the accountant's blessing. There's a crucial document we haven't yet discussed, the auditor's report. This report serves as an accountant's endorsement, lending credibility to the company's financial statements. Public companies are required to have their financial reports audited annually by an independent certified public accountant, or CPA. The audit process evaluates whether the statements are in line with accounting principles and genuinely represent the company's financial health. This auditing involves risk assessment, test sampling, document inspection, account balance confirmation, internal control evaluation, and result analysis. Auditors don't scrutinize every transaction but aim to reasonably verify overall accuracy. A standard audit report typically confirms that the statements are presented fairly and in accordance with accounting principles. Auditors can also issue specialized opinions. Qualified opinions flag issues like insufficient evidence or minor deviations from accounting standards, without indicating major inaccuracies. More concerning are adverse opinions due to significant distortions, or disclaimed opinions when considerable uncertainty hampers fair presentation. A clean audit report reassures investors about the reliability of financial statements, while qualified opinions raise concerns without drastically affecting credibility. Adverse and disclaimer opinions, however, indicate unreliable reports. Beyond these opinions, auditors may include paragraphs that spotlight specific issues such as bankruptcy risk or material uncertainties requiring extra caution. This extra detail enhances auditor independence and transparency. While the auditor's endorsement provides assurance, remember that some level of managerial manipulation can occur. Profit numbers may be smoothed out to lessen volatility, and complete transparency on matters like strategy or product margins might not be provided. Always approach financial statements with a healthy dose of skepticism, considering how the numbers were derived and the level of transparency around key factors. The polished, vividly colored financial documents you see are not the whole story. Balancing rigor with realistic expectations is key for both managers and investors. That's the end of today's sharing. If you like our content, please give us a thumb up and share it with your friends. See you next time.